Now that we've covered the basics of input tax credit, including negative list and proportionate credit, it's now time to check out how the set-off chain works, the GST set-off chain works, and how to calculate input tax credit and the set-offs. Let's start off with the set-off chain. In the first module, if you recall, we had discussed that there are only 3 types of taxes under the GST tax regime: the IGST, integrated GST, CGST, which is central GST, and SGST, which is state GST. IGST is for interstate supply. Interstate purchases and sales would attract IGST, while intrastate purchases and sale would attract both CGST and SGST, because CGST and SGST are concurrent taxes on the same base. You will have to pay both the taxes on the same supplies. So this was the quick recap of 3 tax structures. Both purchases and sales would attract IGST, CGST and SGST depending on whether they are interstate or intrastate. How does the credit chain work? You purchase goods on which you would pay input tax on inward supply, IGST or CGST and SGST, 2 types. On this input tax, you can claim input tax credit by reducing from your output tax liability according to the set of rules. Your output tax liability would also include IGST or CGST and SGST. So basically, input tax credit is for all the 3, IGST, CGST and SGST, and the set-off mechanism tells you which output tax liability of these 3 can be set off against which input tax liability. So you have input tax all 3 and output tax all 3. Which of these can be set off against what? A basic point to remember here is that you can treat IGST as a jewel in your hands. It's something that will help you set off anything. How? Let's take a look. If you have input tax credit, if you've paid input tax of IGST and you have output tax liability of IGST, CGST and SGST, you can actually knock off all 3 with IGST. You can reduce your input tax IGST against all 3. But if you have CGST, you can use it to knock off IGST and CGST. So IGST works both ways. You can knock off any of the tax against it, and it can be knocked off against any other tax, vice versa possible as well. Let's take the case of SGST. As you would guess, IGST can be knocked off as well as SGST. So with this thing in mind, we can form 2 rules. These rules are not specified anywhere, but from our study of the set-off mechanism, we can form 2 broad rules. Rule 1. Any tax, whether it's CGST, IGST or SGST, can be set off against itself. And Rule 2. Any tax can be set off against IGST and vice versa. That's why IGST is a jewel in your hand. So now you know how the set-off mechanism works. We've not yet taken into account the interstate and intrastate play, but that's a broad set of rules for you. With this, we can form the steps involved in input tax credit claim. First, you have the inward supplies. You identify what inward supplies are used for what: business, non-business, taxable, exempt or negative list. Based on that, you would know on which of these inward supplies can you claim input tax credit. So you record the taxes paid as eligible for ITC and separate them as IGST, CGST and SGST. Next, you would, of course, supply goods, outward supplies, and you'll segregate your supplies into interstate and intrastate supplies. On these outward supplies, you will calculate your output tax liability and again separate it for the 3 taxes: IGST, CGST and SGST. And finally, you will claim input tax credit based on the set of rules and pay only net output tax liability. So those are the broad steps involved in input tax credit claim. In the next lecture, we'll look at the situations involved: interstate purchases, interstate sales, intrastate purchases, and intrastate sales.